Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. As the lead-in indicated, this is sort of a different take on the investment show. Our objective is not to provide investment advice, buy this stock, sell this one, etc. I'm not a licensed investment professional. Rather, I'm a securities attorney who represents investors in claims against brokerage firms. So the objective of the show is to pass along some of the information that I've picked up through the course of my practice to hopefully better educate the general public about some of the things that we've seen, tips on how to avoid becoming a victim of a fraud, questions to ask your financial advisor, ways to get information on your financial advisor so that you can have a more productive relationship with that person. So that's what we're going to do each week is tackle different topics, pass along some of that information, and hopefully give you some things that will be beneficial so that you can continue to have or will have in the future a good relationship with your financial advisor, because there's no question that that's an important relationship. Obviously, you're entrusting your entire life savings with this person, and you want to make sure you're doing it with the right person, and that you're making sure that you have an equal footing with that person from an education standpoint, so that you're asking the right questions and getting the right advice. So this week we're going to do something a little bit different, still on topic, but sort of conveyed in a different way. We're going to talk about a movie, and I'm not going to give a movie review, although I did think it was excellent. Nor am I going to talk about, the relative attractiveness of our leading characters or anything like that. But my wife and I did see The Big Short recently. And as I said, it is excellent. But more importantly, it's almost directly on point with what we do. And I did have sort of a take from that movie that I thought might be beneficial to our audience. So The Big Short, if you haven't seen it or heard about it, is sort of a detailed, almost documentary style discussion of what happened in 2008, what led up to it, in terms of the real estate market collapse, and more specifically, the subprime mortgage-backed securities that were propping up the market at that time. It goes into great detail about what occurred and some of the people who foresaw it and how they bet against it and how they made out huge. But what was more intriguing in terms of being on point with what we generally talk about on this show was the complicitness of the banks, the fees that everyone was generating, and sort of what created this environment that led to it. Because really what it was is there's just so much money that was being made by the banks on Wall Street that this bubble occurred, where you started out, and they talk about this in the movie, but apparently there was a banker in the 70s who came up with the first mortgage-backed security. And at the time, it made a ton of sense in terms of getting this started, because if you're a bank and you're lending to one person, obviously your focus on the creditworthiness of that particular lender, their ability to repay, and the likelihood that they'll pay to term. There's risk in there just because things change, or maybe you've got misinformation from your lender, the person who's lending the money, and so the idea was let's package this person who's got great credit rating with these 1,000 people who also have great credit rating. Let's package together almost like a mutual fund, which will allow for diversification. So if you have 1, 2, 3 defaults, not a big deal. You still have 997 people still paying their mortgage. And so that was the idea in the 70s that created mortgage-backed securities, and that in and of itself was probably a great thing, great product, and again allowed for a diversification of risk and allowed them to securitize mortgages. So instead of having just a bank lending to one person, they instead created an investment where you could buy these mortgage-backed securities with the understanding that we're essentially buying a huge number of mortgage portfolio with lots of people who are borrowing, but we're spreading out our risks so that we have isolated defaults. It's not going to be a big deal. We still have all these other people who are still paying their mortgage. So that was sort of the genesis of where they started the movie, and what got things going was the creation of this product. And where it went from there was talking about sort of the evolution and almost like bastardization of this good idea initially, where it got to a point where the fees that bankers were making off of creating these investments caused an environment where you had the banks and mortgage brokers and the like, who were they're making so much money off of loan generation that they stopped paying as close attention to creditworthiness. And you had, sort of a ballooning of what were called subprime mortgages. And subprime probably always, I'm not a banker, but I assume subprime mortgages always existed. But the problem was, in these creation of mortgage-backed securities, the understanding of the industry and certainly of the investors who were buying them was that they were AAA rated investments full of investors who were of great credit, who had a high likelihood of repaying the loans. And so as you started to have more subprime loans entering the market, they were sort of packaged in with these investments, and the number of subprime lenders or people who had subprime mortgages started to creep up to very high levels in these mortgage-backed securities. And the guy they specifically focus on in the movie, who's played by Christian Bale, is a doctor who ran a hedge fund in California, and he really started looking into the specifics of these actual mortgage-backed securities. He would look at specific offerings and realized that the percentage of subprime loans in these baskets was much higher than people knew. And so he predicted, although interestingly, he did it about 2 years early because, as we've mentioned in other episodes, timing the market is almost impossible. So even though you had a guy who predicted this collapse, he still predicted it 2 years before it actually happened. And that's because it's so difficult to time the market. But point is, he predicted that mortgage defaults would reach certain levels where the investments in total would collapse because there were about 20% in certain offerings where 20% of them were subprime loans, and it would only take a default rate of between, I forget the exact specifics from the movie, but between 6-8%. And if defaults rose above that, it'd blow out the whole investment and creep over, even though you still had, a good chunk of the mortgages that were in these mortgage-backed securities, even though a good chunk of them were still very high, very high credit rating people who were borrowing money. The default rates, if they reached a certain point, would blow out the whole investment. So again, he sort of foresaw this, but the ultimate problem was just this increased capacity of loans, and this fee arrangement where the banks and everybody who were putting together deals were making so much money that you started putting people in homes that they didn't really qualify for them. And I remember this from personal experience. My wife and I bought a house in January of 2007 in South Florida at a point where the market had just started to dip. And being the investment savvy person that I am, I thought buying opportunity. So we bought a house with the intention of flipping. And as anyone who owns real estate in Florida knows, that didn't work out. But point is, I remember getting that loan and thinking it was very odd that the loan was characterized as a income only, no verification loan, which meant that they were qualifying me solely based off of my income, and they didn't need to verify it. And I remember thinking at the time, that's really strange, but of course it's okay because I wasn't lying about my income. And so I knew I actually did qualify for the loan, but it made it very apparent to me that it would be pretty easy to get this loan, even if I didn't qualify, because all I'd have to do is puff up my income. And so, in that kind of environment, you undoubtedly had people getting mortgages that didn't qualify for them. And then what they would do is again, as part of the mortgage-backed security process, the securitization of mortgages, is they just lump them up with a bunch of other mortgages, package it, and then the rating services would continue to call these things AAA. And they use some great examples from the movie, which I'm sure are exaggerations to, maximize the benefit of, the viewers. But, the Steve Carell character goes to visit South Florida. I mean, they're going through neighborhoods where there's no one really even living there. He meets with a stripper, actually, who says she owns 7 houses, and that her mortgage broker told her, worst case scenario, you can just refinance. But I remember that environment, and there were a lot of people who were spread very thin just because the real estate market was going up and everyone thought it would go up forever. And so you would borrow as much as you possibly can to try to play that market. And again, it's sort of, at least in the movie, they highlight it as it was the banks who were just looking to do more loans because they made so much money doing the loans, and then they made a bunch of money once they immediately sold the loan, and they packaged it as security, and there was just fees at every step of that process. Mortgage brokers are making money, the lenders are making money, the bankers who put together the mortgage-backed securities are making the money, and then they even went one step further and started packaging the mortgage-backed securities together and called them a CDO, and they made money doing that. And so you just had this sort of self-fulfilling movement of just a humongous bubble. And what I thought made that interesting, at least for purposes of what we talk about on this show, is number one, that is directly correlative to what we see in terms of the fee motivation that can happen at these large Wall Street firms, where you have sort of a culture of maximizing fees, and then you've got financial advisors who maybe sort of abuse that process and take it to lengths that the people who came up with the policies didn't envision. And that can hurt specific investors who now are in products they shouldn't be in. And through our practice, we didn't really seek situations where individual investors were buying up these mortgage-backed securities. I mean, I think generally bankers, when they were selling them to institutional investors, pensions, that kind of thing. But the same basic problems would exist there in terms of the maximized fees at the expense of the client. And we certainly still continue to see that, up until today. The other thing that was interesting in the movie that we do see, and we've seen it recently actually, is sort of the way these rating agencies can in times be complicit to what's happening. The example they used in the movie is that you had the default ratio reach a certain point where the people who were betting against the real estate market knew that these things were struggling now, but the rating for the investments was still AAA. And the Steve Carell character goes to visit somebody at S&P, which is a rating agency like Moody's, and says, how can this be? Our default ratios are up. The money coming in from people who have mortgages is going down, and yet you still have the investment, rated the same and worth the same. How can that possibly be? And I'm sure this didn't happen because I can imagine somebody at a rating agency saying this, but basically the woman says, well, if we didn't rate it AAA, they'd just go down the street to Moody's and they would. And again, I doubt anyone would actually admit that, but certainly there's some truth there where the rating agencies get paid to rate these things. And if they don't get the rating that the banks want, that there are competitors. And you do see that. And I question some of the things that are out there now. Again, in our practice, we're looking at a lot of these oil and gas master limited partnerships, MLPs, which are down considerably. But what's particularly frightening to me about them is that the assets of the MLPs are priced by the sponsor of the investment. So if you've got, Lynn Energy is one of them, Lynn Energy MLP, and they're going to pay X% income, and they're going to say, okay, this is what our assets are worth. And that is sort of how the price of the investment is figured out. The underlying asset that people are relying on when they set the price, when they buy and sell it publicly, are looking at a number that it can be sort of artificially created. And that was similar to what occurred when the market collapsed in 2008, is that you had banks who were putting in their products and they would price it as AAA rated, this is as safe as it gets. Meanwhile, the underlying investments in there included a bunch of junk. And again, that's correlative to what's going on now in the market. And that's not time specific, by the way. That happens virtually all the time. And Wall Street is set up to make money, and they're very good at it. And they continue to sort of repackage the same investments over and over and over again, and they'll just call them something else, but they'll have the same basic structure. Mortgage-backed securities still around; they still exist. Now, whether or not the underlying investments have gotten bad, I don't know. Certainly, as anyone who's bought a house recently can attest, the standard has flipped the complete opposite direction. Whereas it used to be, you could just sign a piece of paper that said, this is my income, and they're not even going to ask for a W-2 or a tax return. Now they want to see absolutely everything. I'm self-employed running my own law firm. And I mean, I can't tell you how many documents the bank wanted to see before they would actually qualify us for buying a house. I think about 3 years ago, it was again, the pendulum is swung the other direction. So I kind of doubt that these mortgage-backed securities have so many subprime mortgages, but that doesn't stop Wall Street from sort of just repackaging the same basic type of investment and just doing it again. Again, we see it in our practice where, 7-8 years ago, the investment of choice were non-traded REITs that paid huge commissions to financial advisors, huge commissions to the firm for doing due diligence. And not only are they still selling that investment now, even though the vast majority of them tanked with the real estate collapse, but now they've also started a new investment, which is called a BDC, Business Development Company, structured exactly the same way, high commissions, a liquid, self-priced by the BDC who puts it together. And now they're out there selling those. And it's because if you kept coming at people saying, hey, we got these great non-traded REITs, and you say, well, you screwed me on that one 8 years ago, I'm not buying that again. So now they got to come up with a new name for it. But it structurally is the same. It works differently. And the underlying investments aren't real estate necessarily. It depends on the BDC, but the structure is identical. And this goes back, 20, 30 years, as far back as I've been doing this kind of work. I mean, in the mid-90s, they were Prudential limited partnerships. At the dot-com crash, you had other products, structured products created by banks. They just keep doing this. So that was sort of my takeaway from the movie. And I thought it was really interesting. I'm walking out, and somebody who was in the movie says, did you just come out of The Big Short? And I said, I did. And he said, can you believe they did that? And I said, yeah, I actually can. Do you want to stick around and have a 20-minute conversation about it? Because this is what I do. And I didn't actually say that because it was obvious that's not what the guy wanted. But the point is, yeah, I believe it because we see it. We see it in our practice. And that was sort of the big takeaway. The other thing that was interesting, and this speaks not necessarily to our practice, but to the bailout, which everyone is sort of familiar with, but doesn't necessarily understand it or get what occurred there. But it's all related to this same real estate bet that this doctor in California sort of foresaw. But the part that he didn't necessarily see coming was just how bad it was going to be. And the bailout was because the banks had so much exposure on these mortgage-backed securities when things actually went bad, they didn't even have enough money to cover all these debts. So, that's why our government had to step in, prop them up, because of course the concern was that the entire lending system and banking system would collapse otherwise. And whether or not that's true or not, I don't know. But the point is that the exposure of the banks at that point was so enormous that even the people who bet against it were worried that they wouldn't get paid because, of course, the investment they made to bet against it was backed by the banks themselves. So that they bought what were called credit default swaps, which basically means if these investments tank, then you have to pay me. But if they don't tank, I have to pay a premium for the benefit of owning this credit default swap. But the problem was when it came time to actually cash in on these bets that they made against the real estate market, some of the banks were about to go under. So they had to take discounts just to make sure they got something. The other takeaway that I had, was sort of thinking about Dodd-Frank and whether or not that's actually working. It seems like from the experts that talk about it, we obviously had some volatility in the market the last 2 weeks, but people don't seem to be concerned about the same sort of systemic problems. And again, talking real life examples, I would again sort of cite to how much more difficult it is to get a loan. It certainly seems that there has been a huge shift away from that kind of exposure in the lending industry and the banking industry. But the point is, and again, the larger takeaway is, that Wall Street repackages these things. They made a ton of money. That's what created the problem, was all the fees they were making. and that's very well highlighted in the film. But just because they've cleaned up one area, don't think that they're not necessarily working on the next thing that pays them a ton of money. So anyway, we're gonna take a break, and then when I come back, we'll finish things up.
Hello, I'm Brian Combs, former Vice President and General Manager of Bugmaster, now the co-owner of Compass Pest Control. We offer the personalized service we know you expect from a locally owned and operated pest control company. With over 33 years experience in the pest control and lawn and landscape business, and as the former Indian River County Extension Agent, I want to be of service to you. Call Compass Pest Control 772-766-9098 or visit compasspest.com. PESTS.
It's time to call Easy Brew Coffee and Bottled Water Service and learn just how much you can save and how convenient it is to have your coffee and bottled water delivered right to your home or office. In addition to water coolers, Easy Brew offers individual bottles of water in 8 or 16-ounce bottles. No more lugging it home or dragging it into the office. Serving the Treasure Coast for over 2 decades, 2 letters, 1 simple name. Easy for Easy Brew. Visit e-zbrew.com or call 800-792-3285. Easy Brew.
Wish you had more time for fun in the sun with your family? Bogged down with that never-ending list? The shopping, chauffeuring, arranging, organizing, and don't forget the pet appointments. Maybe you have a birthday or anniversary plans to make. It's all so time-consuming. Let Lifestyle Concierge of Vero Beach help you get things done. We're that extra pair of hands you need to balance your day. We offer customized, affordable services to fit your needs. Call 772-217-2160 or visit us online at www.conciergevero.com. Lifestyle Concierge of Vero Beach, making life easier every day.
Welcome back, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. Before the break, we talked about the movie The Big Short and sort of, the frightening aspects of what occurred in 2008 and how we ended up with the Great Recession and, some of the things that were going behind the scenes and parallels to things that we're still seeing today. And again, the large takeaway was that I do think that the banking industry has been cleaned up, but that doesn't mean there aren't still problems. Obviously, the next time we have a recession, it won't be the same. It'll be something different. Right now we're very focused in our practice on oil and gas investments because, with oil down from 100 to 30, you're seeing a lot of problems, whether they be MLPs or oil and gas junk bonds or what have you. There's a lot of energy specific problems out there. But it does flow over to banking in a way that would be kind of similar to what occurred in The Big Short, although I don't think that the exposure is nearly as great. But I did read an article this week where the Dallas Fed asked some of their local banks not to price their oil and gas investments to market for fear of making it seem like their balance sheets were worse than is currently being put out there to the public. So certainly banks have some exposure there. And you're going to see some repricing of those assets in the future, and I wonder what that will do to the banking industry. I think that's sort of been reflected over the last couple of weeks in what's going on in just the market in general, as people worry about, lower gas prices are great for you and me, the consumer, when we gas up, and it's cheaper, and maybe we'll take a trip that we weren't going to take and that kind of stuff. But at the end of the day, if prices get so low, where one of our biggest industries falls apart. That's going to have a systemic problem with the industry, and financials are probably going to be the first ones hit just because they, of course, are the ones lending money to these companies. So anyway, thanks for listening. If you want some more information on how to improve your relationship with your financial advisor, check us out at wallstreetvmainstreet.com, or you can go to the law firm website, which is whitesecuritieslaw.com, and we've got great information there on how to research your broker, how to protect yourself from fraud, all that good stuff. Thanks.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.